Visa just confirmed its stablecoin platform is processing more than $1 billion in monthly volume. JP Morgan and MasterCard are doing the same, and the CEO of Coinbase just told Washington that over $30 trillion is ready to enter this infrastructure the moment the Clarity Act passes. Before we go any further, did you know that Visa was already running stablecoin transactions at this scale? Drop a yes or no in the comments right now. I am genuinely curious how many people in this community are already tracking this. This is not financial advice. This content is for educational and formational purposes only. Always do your own research before making any financial decisions. If this kind of global institutional coverage is useful to you, hit the like button. It helps this reach more people who need to see it. Now let me walk you through exactly what happened and what it means for the thesis you have been holding. To understand why what Visa just said matters, you need to understand one thing first. Visa is not a crypto company. They are one of the most conservative, most scrutinized financial institutions in the world. They have shareholders. They have regulators watching every decision they make. They have a reputation built over decades that they are not willing to put at risk on an unproven idea. When Visa publicly confirms that their stablecoin processing platform is handling more than $1 billion in monthly volume, they are not making a speculative bet. They have already made a calculated business decision. They have run the numbers, stress-tested the technology, and determined that this is worth the public commitment that matters in a way that a smaller or newer company making the same announcement simply would not. Visa operates a settlement layer that allows financial institutions, payment processors, and card programs to settle transactions using digital currencies, including stablecoins. A stablecoin is a digital currency pegged to a traditional currency like the US dollar. So one unit always equals $1 in value. Its purpose is not speculation. It is designed for speed, stability, and traceability. RLUSD is a dollar-backed stablecoin that runs on the XRP ledger. When Visa confirms it is processing more than $1 billion in monthly volume through this kind of infrastructure, that is a direct, measurable indicator of real-world utility. The reason this model makes commercial sense for Visa comes down to one structural advantage. Payment providers operating at this scale hold enormous amounts of financial reserves. When those reserves are held in instruments like treasury bills, they earn interest. The shift to stablecoin infrastructure does not eliminate that advantage. It complements it. Visa can hold the underlying reserves, earn the yield on them, and simultaneously run a faster, more efficient payment network. That is not a trade-off. That is a structural improvement to an already profitable business model. The technology makes sense on the numbers, which is the only reason a company like Visa would commit to it publicly. The part of this story that received the least attention is also the most significant. MasterCard and JP Morgan are also processing stablecoin transactions. That fact was mentioned briefly in the coverage and then moved past. It should not be. MasterCard and JP Morgan are two of the most recognized names in global finance. These are not forward-looking startups experimenting with early-stage technology. These are institutions that process trillions of dollars in transactions every year. Their legal and compliance teams exist specifically to evaluate whether any new system is stable enough, legal enough, and trustworthy enough to be used at scale. When Visa, MasterCard, and JP Morgan each arrive at the same conclusion about stablecoin infrastructure independently, through different risk frameworks and different corporate structures, that is not coincidence. That is the result of 3 separate rigorous institutional analyses, all landing in the same place. The scale of what they are collectively processing is worth pausing on. The global stablecoin market is already handling tens of trillions of dollars annually. That number already exceeds traditional card rails in raw throughput, meaning the total transaction volume running through stablecoin infrastructure is larger than what traditional payment cards move, not projected to exceed already exceeding. That said, raw volume alone can sometimes be inflated by automated systems that generate artificial transaction activity, what the industry calls wash trading bots. When you filter those out and focus on the adjusted figures that reflect genuine institutional payment utility, what remains is the cleaner picture. And that adjusted picture has shown steady, consistent growth driven by real demand. The Clarity Act is the piece of legislation that sits at the center of the regulatory picture right now. In plain terms, it is a bill that would create clear rules for digital assets in the United States, defining which assets fall under which regulatory category, which government body has oversight, and what legal obligations institutions face when working with digital asset infrastructure. One of the primary reasons some institutions have remained cautious is exactly this kind of unresolved legal question. Once the Clarity Act passes, those questions get answered. The White House has stated that they want this done before July 4th. That is not an idle comment from a minor official. It signals that this legislation is being treated as a near-term priority at the highest levels of government. The Coinbase CEO has confirmed that Washington is preparing to accelerate crypto rulemaking connected to what he described as the $30 trillion plus U.S. financial system. Over $30 trillion is tied up in U.S. financial markets. The argument being made is that digital asset infrastructure, stablecoin payments, tokenization of traditional financial assets, and digital settlement systems will gain access to that entire pool. Tokenization, in the simplest terms, is the process of turning a traditional financial asset into a digital token that can be transferred and settled on a blockchain. The efficiency gains this enables are the reason institutions at this scale are committed to the transition. The question that follows from all of this, and the one that runs directly into what we cover next, is about timing. If the infrastructure is already running at tens of trillions, if 3 of the world's most scrutinized financial institutions are already committed, and if the Clarity Act has not even passed yet, what happens to all of that when it does? To answer that, you have to look at what is happening in the macro environment right now, because institutional adoption is only one side of the picture. The other side is capital availability, and that side is changing. China recently injected 304 billion yuan into its financial markets in a single week. China's economy was approaching what economists describe as a deflationary state, a condition where prices fall, consumer spending slows, and the economy can get trapped in a cycle of declining activity. The government's response was direct intervention. Inject capital into the system to increase the available money supply and restart economic momentum. 304 billion yuan in a single week is not a minor adjustment. It is a large-scale, deliberate injection of capital into circulation. And China is not operating in isolation. When you look at the global money supply, the metric economists call M2, it has been rising consistently since March. Multiple major economies around the world are expanding their circulating currency supply simultaneously. More money in the system means more capital eventually finding its way into investment markets. For digital assets specifically, this matters because there is a documented historical relationship between rising global liquidity and price movement in markets like XRP. But the relationship is not immediate. Capital does not move that fast. The historical lag between new liquidity entering the global financial system and that capital materially affecting digital asset prices has consistently been approximately 3 to 4 months. It moves through traditional asset classes first, then gradually migrates toward higher risk, higher return investments. If the global M2 expansion began in March, a 3 to 4 month lag places the window of potential price impact somewhere in the June through September timeframe. The data points in that direction. The bear market cycle adds a second layer of structural context. October of last year was when the current bear market for XRP and the broader crypto space began. That means October of this year marks the 12-month point. This is not an arbitrary number. 2 of the 3 most recent bear markets in this space lasted approximately 12 months. If the current cycle follows the same historical pattern, the 12-month mark would coincide with the approaching end of the cycle. When you overlay the liquidity timeline and the cycle timeline, they converge around the same general period. That is the structural backdrop. There is one additional factor creating headwinds in the short term, and it would be incomplete to ignore it. Geopolitical tensions, specifically the situation in the Middle East, have been creating downward pressure on risk assets, including XRP and Bitcoin. These are not XRP-specific problems. They are macro-level uncertainties that push investors towards safety in the short term. The presence of this headwind explains in part why the liquidity cycle has not translated more immediately into price movement. This is a variable to monitor, not a reason to revise the structural thesis. For someone in their late 50s or early 60s, someone who has spent 3 or 4 decades building a financial position they intend to preserve and pass on, the question is not whether the price will move next week. The question is whether the thesis they committed to still has the foundation they believed it had when they first evaluated this space. When Visa is processing $1 billion a month, when global money supply has been expanding since March, when China is injecting hundreds of billions into its own economy to prevent deflation, the thesis is not broken. The infrastructure is being built. The capital conditions are improving. The patience required to be in this position is exactly the kind of patience that long-term investors understand better than anyone. Now add Japan to the picture. Japan is one of the world's major economies. SBI Holdings, one of Japan's prominent financial institutions, has been actively integrating XRP technology into its infrastructure. Japan's first XRP exchange-traded fund is expected to receive approval in the coming years. An ETF is a financial product that trades on a traditional stock exchange, allowing an investor to gain exposure to an underlying asset without directly owning or managing that asset themselves. For the many investors in Japan and across Asia who want structured, regulated access to XRP, an ETF is the clearest and most familiar pathway. You do not need a crypto wallet or a specialized exchange account. You need a standard brokerage account, the kind of account millions of investors in these markets already use for traditional investments. The evidence that demand already exists is concrete. A recent XRP-focused event held in Japan drew record-breaking attendance. These are not casual onlookers. They are people who showed up in large numbers specifically to engage with this asset class, and who in many cases are still waiting for the formal access point that an ETF would provide. The demand does not need to be manufactured. It needs a door. That same dynamic plays out across Europe and the rest of Asia. Economies representing tens of trillions of dollars in combined investment capital do not yet have established ETF frameworks for XRP. XRP ETFs already exist in a number of countries, but the full picture of global ETF access has not been completed. Each new market that opens a formal regulated investment vehicle for XRP represents a wave of long-term capital that previously had no clean pathway in not speculative capital. institutional and retirement-oriented capital, the kind that moves slowly but moves in large sustained volumes. The question that sits just beneath the surface of everything we have covered, the one that most coverage of this story has not yet fully addressed, is this. When Japan's ETF formally arrives and Asian investors gain structured, regulated access at scale, what does that mean for the infrastructure that Visa, MasterCard, and JP Morgan are already running? The payment rails will already be in place. The settlement infrastructure will already be tested and operational. The new demand wave will arrive into a system that has been built over years. That is a convergence worth understanding clearly. When you step back and look at what all of this describes together, the picture is more coherent than individual news items might suggest. Visa, MasterCard, and JP Morgan each made their commitments to stablecoin infrastructure through independent analyses, separate boards, separate risk teams, separate legal reviews. All three arrived at the same answer. For someone who has watched how the financial industry actually makes decisions, that kind of convergence means something. Large institutions do not make this kind of commitment without a clear commercial reason. They have all found one. The regulatory layer is moving too. The Clarity Act is proceeding through Washington with executive-level urgency behind it. The legal ambiguity that gave some institutions a reason to wait is being resolved. When it passes, the institutions that have been holding position will have what they need to act fully. On the macro side, global money supply has been expanding since March. China injected 304 billion yuan in a single week to prevent its economy from entering a deflationary state. The historical pattern between new liquidity entering the system and digital asset price movement has consistently run 3 to 4 months. The current bear market for XRP began in October of last year, and October of this year marks the 12-month point, a time frame that has coincided with cycle transitions in 2 of the 3 most recent bear markets. These are not guarantees of any outcome. They are structural conditions that have historically preceded meaningful moves, and access is expanding. Japan's ETF approval is expected in the coming years. Tens of trillions in Asian and European investment capital are still waiting for formal on-ramps. SBI Holdings is already integrated. The record-breaking attendance at Japan's XRP event shows that demand is not a projection. It is a documented reality waiting for a gateway. What this adds up to for a long-term investor who has held a position through a 12-month period of skepticism and noise from people who did not understand why you were watching this space so carefully is a picture where the thesis is intact and the conditions are progressing. Every major institution that the most skeptical voices in your life have trusted with their savings for decades has independently decided to commit to this infrastructure. That is not a minor development. Visa is not a company that takes risks for entertainment. JP Morgan is not a bank that chases unproven trends. When institutions like these commit, they commit because they have run the numbers and the numbers work. The Clarity Act will give them the legal framework they were waiting for. The capital cycle is moving in the right direction, and the next major access event, Japan's ETF, is approaching on its own timeline. The one thread we will be watching closely is what actually happens when Japan formally approves and the Asian access wave begins. That story is still developing, and when it does, we will cover it here. Before I sign off, I want to ask you something genuine. Does anyone in your immediate circle, family, close friends, people you respect financially, actually know that Visa, MasterCard, and JP Morgan are all processing stablecoin transactions at this scale right now? Drop your answer below. I am genuinely curious if this video gave you a clearer picture of what is actually happening. Go ahead and like it. It helps this channel reach more people who need to see this. And subscribe so you do not miss the next one. Share this with someone in your circle who is only following domestic crypto news and has no idea what is happening globally. Stay informed, stay positioned. I will see you in the next.